I want to thank everybody for joining me today for the latest in my Ask Me Anything series, Dow 30,000, What's Next? I also want to wish everybody a happy new year. I hope your year's gotten off to a good start. And just a little housekeeping. So I started these last year, now going to be on a much more regular schedule. My goal this year is to have Ask Me Anything sessions twice a month. It'll be on the second Thursday of the month at 5 p.m. And then it'll be on the fourth Thursday of the month at 12:30. So that way I allow for people that can't make it late or can't make it at lunchtime. So I'm going to switch them back and forth, but that's going to be the regular schedule, except for if things like holidays get in the way. So last year, 2020, it was a crazy year for markets. We had things happen that we haven't really seen in the past. In the first quarter, the stock market started off great. We set an all-time high on February 19th. But then about a month later, the market was down 34%, one of the fastest drops we've ever seen the S&P have. Then in the second quarter, the S&P recovered by 20%. It was one of the best quarters the S&P ever had. By August, we were back to all-time highs. Through the end of the year, we had an all-time high 19 more times, and the fourth quarter gain was 11.7%. That's a pretty crazy year, and we ended up 16% for the year, which, again, in a year that you're down 34%, that's not something we should expect to see too many times. It was much more volatility than normal. So what drove the market's recovery? There's a few things that would be the primary factors. We had a lot of government stimulus. Also, even though so many people were unfortunately lost their jobs, that happened at the lower end of the wage scale. So employee compensation, despite all the unemployment, only fell by 0.5%. Unemployment benefits were boosted. That added almost $500 billion of stimulus. After-tax personal income, because of that increase in unemployment primarily and the stimulus, was up by a little over $1 trillion. Spending on services fell by almost $600 billion. Spending on stuff, and that's kind of like something that we thought that people were spending more on experiences. Well, when they couldn't spend as much on experiences, they did increase their spending on stuff. And then personal savings skyrocketed. So that means that there's potentially a lot of pent-up demand in the economy because people didn't spend and they saved much more than usual. Also meant that there's a lot less interest payment because people were able to do things like pay down their credit cards. And just to give you an idea of how crazy things have gotten, and I'm not commenting on the valuation of Tesla stock per se, but I just thought this was a really interesting chart. So Tesla is the one on the bottom. It's got a market cap of $805 billion as of earlier this week. If you take the top 10 auto companies and add them all up, their market cap is $672 billion. The gross revenue that Tesla had over the last 12 months was $28 billion. The gross revenue of those other 10 companies was $1.3 trillion. Does seem a little bit out of whack. But Tesla has continued to perform into this year, so we shall see. Let's look a little bit more under the market's hood and what happened. Last year, U.S. equities continued to outperform those outside the U.S. U.S. equities have had better growth, better margins, and that's a big reason why they've outperformed. Value stocks strongly lag growth stocks. That's happened for the last 10 years. Over the previous 8 decades, value outperformed growth every time. And according to Bloomberg, value beat growth 90% of the time over rolling 10-year periods counted monthly. And the other thing that we saw happen was large cap stocks were the clear market leaders. And a lot of those were these internet companies that had a lot of e-commerce business. So as people couldn't get out, they were ordering more and more things over the internet. This is one of my favorite tools or charts for asset allocation. It's the asset allocation quilt. So what it does is it looks at how different market categories or asset classes have performed each year. So you can see that the last 2 years, large caps outperformed all other market all other asset classes. And for the whole last 10 years, large caps were never worse than fourth. Commodities, which is that light bluish, sky bluish color, you can see how difficult it's been to be an investor in commodities. The best year that you had relative to the other asset classes for commodities was in 2018 when they were 8th out of the 10 here. Emerging markets, there can be a lot of volatility there. They're all over the map. You have some years where they're good, some years where they're bad. You can see that emerging markets, which are the yellow square, in 2012 and 2017, they were first. Last year, they were second. But then you had years like 2011 and 2017 or 2018 where they were last. And it was also a tough year to be a REIT investor. Typically, people look to REITs, that's real estate investment trusts, as a source of income. Pretty consistent performers. You can see that's the dark blue box. And in some years, the REITs were the best performers. It started off the first 5 years. You see the REITs were second, third, sixth, and then first and first. Been a little bit tougher sledding since, especially last year, where REITs were the worst performing asset class. So I mentioned value versus growth. Let's take a closer look at that. Value stocks traditionally are thought as something that could be less riskier than growth stocks, but maybe they're not. A value stock typically has a dimmer or weaker business outlook. Value stocks typically carry more debt, and they can often be much less profitable. If I think about it in terms of categories, I used to cover oil and gas stocks, and oil and gas stocks are traditionally value stocks, right? They don't have a great business outlook. They do have a lot of debt, and that's because they're so capital intensive. And profitability wise, if I look at their profit margins, they're much less profitable. If you compare those oil and gas stocks to stocks that are in the healthcare industry or the technology industry, the profitability is much different. What is value investing? Value investing is basically buying something that's intrinsically believed to be worth more due to fundamental cash flow generating capabilities, and you're buying at a price that represents a meaningful discount from value. The issue, though, is determining price can be challenging. You have to make numerous assumptions. Value investors are also renowned for the view that they're buying ownership in a business and not pieces of paper. And that's something that you hear Buffett say all the time. And we're buying a business. We're not just buying pieces of paper. Successful investing reflects superior judgments concerning qualitative, non-comparable factors and a view of the future. Companies that are successful today, they have different cost structures, different capital requirements, and different profitability. And I gave the example of oil and gas versus technology earlier. Value can be found in many forms. High valuation metrics, such as price earnings ratios, price to sales ratios, price to books ratios, don't always equate to overvaluation. Low metrics don't always reflect bargains either. And part of the reason is accounting has a big impact on that. And why do I say that? Because in accounting, intangible assets, what I mean by intangible assets would be things like trademarks and trade names, and the value of research and development and advertising and all those spending, those amounts under accounting are written off. They're expensed in the year they're incurred typically. On the other hand, if I buy buildings and I buy property and I buy machinery and I buy equipment, I write those off over the estimated useful life of the property. So that a company that's very asset intensive has a higher book value than one that's very asset light. And the real question is, should value and growth be mutually exclusive? Buffett and others have said things along the lines of, I'm buying a company because I think it's a value. Why should value and growth be mutually exclusive? Why would I want to overpay for a company? So it's not so simple as saying that value and growth are so distinct. We're always looking to buy stocks at a discount to whatever we think their value is, unless you're a different type of investors. I mean, there are investors that do things like based on charts and momentum and things like that, and those stocks may or may not have those same characteristics and be looked at the same way. What does all this tell us? Well, nobody knows what will happen next. When I was an analyst covering oil and gas stocks, I used to get called on a regular basis by media people, and they'd say, so Phil, what's your outlook for oil prices? And my answer was typically something like this. Here's the thing. As part of my job, I'm supposed to forecast oil prices. So I'm going to give you a number. I'll also tell you another thing. There's one number that I think the price is not going to be. And that's the number that I'm about to give you as my forecast. I did that for 7 years. That meant I did it for 28 quarters. One quarter, I hit it on the nose. And that was just pure luck. And why is that? Because there's so many factors that are unforeseeable that we can't predict, we can't forecast. You know, oil in particular, in some countries, it's such a big part of the economy, and we don't have the rational laws of supply and demand. They don't always apply. So that happens too with markets. People are not good at forecasting the markets either. Nobody knows what will happen next. Anytime we have big market events, if you can find one or two people that forecast them, that's unusual. And more than that, it's very unusual. It's hard. Right? History doesn't always repeat. What worked last year, it might not work this year. Buying and selling is also hard. The more times you buy and sell, the more decisions you have to make, and the more times you have to be right. So what can we do? We can diversify. We can have exposure to lots of different asset classes. We can have a long-term plan. That's really important. And your process matters. Why should we plan? Well, when it comes to investing, it's really not about beating the market, no matter how much you hear that from the media. It's about living the life you desire. If you want to beat the market, normally that means you're going to take on more risk than the market. That means that if the market has a good year, you have a chance to go up more than the market, but it also means if the market goes down, you have a good chance to go down more than the market because you took on more risk. If you take on more risk and that keeps you from having the lifestyle that you want in retirement, you're not going to be happy. Planning helps you worry less about short-term market fluctuations. Because if you're comfortable that you've invested in a way that's going to help you achieve your goals, you shouldn't have to worry as much about what the market's doing on a day-to-day basis. Planning can make it easier to focus on the long term. I always tell people when I'm talking to prospects that there's two things we want to try to do is avoid as investors: buying high and selling low. So if we can have a process in place that helps to take our emotions out of it, because emotions can play such a big role in the performance of our investments. If we can take those emotions out, that should help increase our chance of success, because we're not going to sell at the bottom. You know, when the market fell in March, you're not going to sell out at the bottom. You're less likely to do that if you have a process that you believe in. And you're also going to be less willing to chase at the top. And if we plan and we're comfortable about our plan and its ability to get us to where we want to go, it can also improve our quality of life. Why? Because that means that we're spending less time listening to talking heads, worrying about what our stock portfolio is doing, and spending more time on what matters the most. So here's why I think having a process matters. This little chart, I think, does a really good job of explaining it. If you think about it, if we have a process to make our decision, we see this box. It shows there's 4 different things that can happen. So if we have a good process and we get a good result, that should mean that we have a deserved success. Sometimes you have a good process and your outcome's still bad. That's a bad break. If we have a bad process and a good outcome, it could just be dumb luck. And a bad process and a bad outcome, you could argue that that's poetic justice. And the key thing about the process is if we have a process that we follow on a regular basis, it also helps us figure out, is what we're doing working? If we're always changing our process and not applying it consistently, it becomes much harder to figure out what we do that's right and what works. We don't really know. So here's some things that we can use the process to help us with. Our asset allocation. What should be our mix between stocks and bonds and cash and whatever other assets we want to hold? What are our rules for rebalancing? For example, my rule for rebalancing is like if I have a 60-40 portfolio, that means 60% stocks and 40% cash and fixed income or bonds. If it gets to 55-45 or 65-35, That's my trigger to try to rebalance it back to my target. Process can help reduce the role of emotions. Another thing that process helps with is asset location. And what that means is every asset that you own, it can throw off different types of income and different types of gain or loss. So you want to think about which asset belongs in which type of account. For example, if you're years from retirement and you have a small allocation to fixed income, you don't really need it. So why should you pay tax on that income right now? That can sit in your IRA or your 401k. And that helps you today because you're not paying tax on the current income. It also can help you in the future because when you pull the money out of that account, it won't have as much growth. And you think, well, it's growing tax-free. Isn't that good? It is, except if I could have that asset in a taxable portfolio or in a Roth IRA where I don't pay any tax when I pull the money out, that's even better because then I'm either paying a reduced capital gains rate on what's in my regular taxable brokerage account, or I'm paying no tax if it comes from a Roth. If I pull that out of my IRA, I pay tax at my full marginal tax rate because it's ordinary income. Process can help us determine when we're going to add new money. We can also have a process to tell us when to sell and a process for withdrawing funds when we get to retirement. Another thing you want to consider too is possibly having a bucket strategy, which can work really well once you're either in or approaching, getting close to retirement. And that bucket strategy, the way I like to think of it is if I look at historically, and I'm going to rule out Japan because Japan's a little bit different, right? But if I rule out Japan, when we've had bad markets, typically they recover in 18 to 24 months. So you might want to take cash or short-term bonds or money market funds and put those 12 to 24 months of your needs into those type of short-term accounts. So that way, if we do have that market dislocation, you can draw from that money and not be forced to sell low. You might also think about what do I need for my medium-term goals, and that can be invested a little bit more aggressively. And as we get out longer term, then we can be much more aggressive, which typically means allocated more heavily towards equities. So you want to think about the nuances of your asset allocation when you're figuring out how you want to allocate your assets. And this can help you, like I said, the purpose of this strategy is to help you keep you from selling in a prolonged bear market and avoid selling low. And then you can replenish that cash when the market recovers. So that's basically what I had to say on the market environment and how to react. I mean, it's basically just kind of think about the long term. We don't know for sure what's going to happen. So you want to invest in a way that's comfortable for you. That's really important. So I have Q&A at the end. Just have a couple slides I want to go through. So I'm always looking to grow my business. And one of the best ways to help grow my business is through personal introductions from people that I know and serve. So as you think about who you could introduce to a prize, here's some things that you might want to look for. And we look at people that are interested in gaining a better understanding of when they can retire and what retirement might look like. In other words, they're looking to put together a financial plan. They might be experiencing some type of life transition. We also like to work with friendly people, right? It's more fun to work with people that are friendly than not. We want to know people that are receptive to having professional relationships. Because of my background, I'd like to work with people that are concerned about income taxes because to me, taxes and investing are joined at the hip, and you want to make sure that you take both into account when you're investing. And then just people that are considering simplifying their life by delegating their financial affairs to a professional. So if you know anybody that might be interested, please give me a call or send an email so we can arrange an introduction. If you'd like to talk to me about any of this, sign up for a free portfolio review, which is an important step and one of the first steps in any financial plan. You're welcome to use this link to my calendar to schedule an appointment at a time that works for you. If you're not on my distribution list, you're also welcome to sign up for that. And now for the Q&A. Now I did get a bunch of questions that I'm going to try and go through that came ahead of time. I'll probably steer a little bit clear of the last one because my views, I know there's local people on this call and I'm from New Jersey, so I'm not a fan of the local teams. The first is compare using technical analysis versus fundamental analysis. I'm aware of technical analysis. It's not really something that I practice. I'm a fundamental analyst. I remember when I was an analyst getting a call from a reporter that I talked to all the time, and he wanted to know something about a chart. And I said, hey, I'm going to be honest. I'm not a guy that looks much at charts. I don't know much about them. He says, don't all you guys know that? I'm like, not really. I mean, it's included in the CFA curriculum that I went through. I do know something about it, but I want to stick with fundamentals. I want to understand the company. I want to understand its business. I want to have an idea what its potential market looks like. I want to have an idea of what its growth opportunities are, those type of things. I want its financial strength. All those things to me matter much more than what a lot of dots on a chart look like. So the next question is related. Are technical analysis in chart patterns a worthwhile tool or overrated? For me, I don't know that I'd say overrated. They're just not something that I use. I mean, I know some people that use those techniques. Some are.
Can I make a comment?
Sure.
I've been in the business for a while, and years ago there was a book written by Edwards and McGee. It's considered the text of technical analysis. It's about 800 pounds, and which is probably pretty good for help flattening things. A book I wrote back in 2010. My chapter heading was Technical Analysis. It's all voodoo. But I'll substantiate that. There's a guy by the name of John Train who wrote a book called The Money Masters, and it was all about some of the great investors of all time. And there was a section on technical analysis. And in this section, John talked about a bet he had willing to make with any of the technical analysts on Wall Street. And he said, here's my bet. I'll give you $10,000 if any of you are willing to predict and can predict accurately where prices are going to go 5-10 years from now using your charts. No one took him up on the bet. It is absolutely meaningless. I mean, I have a strong feeling about it. I don't know that Phil feels that strongly. Fundamental analysis is the name of the game, keeping in mind two things. Whatever happens in the short term is largely determined by changes in investor psychology. Fundamental analysis has great value as time extends. The longer the period you're looking at, the more likely that fundamental analysis can point in the right direction. I'm done.
All right, thank you, Russell. I mean, I agree. Like I said, I know about technical analysis. It was part of my curriculum, but it's not something that I practice. Next question, can you generally rely on analysts? Right, so I was an analyst, right? I did that for 7 years. My view is you need to make your own decisions. I always view analyst reports as something that can help me understand a company, but there's a lot of motivations that come into the recommendations made by analysts because they may be getting paid by the company, they may have a relationship with the company. There's not as much independence as you'd like. And so those buy, sell, and hold ratings, I don't place a lot of faith in those for the most part. Yeah, there's lots of reason to believe that when a company puts a buy and when an investment bank puts a buy on a stock, that they have some that they want to sell. So they're hoping that by upping the price, upping the price targets and upping the recommendations, that'll make more people interested and they'll get a better price for selling them. Also, many analysts are hesitant to put a sell rating on a company because they have a relationship with the company and they don't want to jeopardize it.
I have a comment or two on that one, if you don't mind, Phil.
Go ahead.
Years ago, I was the managing editor of the Value Line Investment Survey. I had 80 analysts working for us. We had a computer-based model for differentiating between stock recommendations, as in better than, same as, or worse than the market. And we used this for decades. For a short period, however, we decided to put the analyst recommendations in there. During that period, our results were worse. We pulled them. The other comment I'll make is that the overwhelming majority of recommendations for analysts are buy. Why? Because they're being paid to sell stock. The problem is that every analyst pretty much has to come up with the same recommendation as anybody else. Because if you make a mistake and you are with everybody else, you have the same kinds of numbers, okay, the crowd made a mistake. If by chance you, however, are dramatically different and you made a mistake, your job may be at stake. So with all due respect to analysts, as Phil said, they help you know more about the company. They do not help you make good choices about stocks.
Thank you, Russell. Next, is a correction in order based on the pricing in the market? Short answer is, I don't know for sure. But in markets, corrections are not uncommon. I think they happen, market goes down. A correction, for those that aren't familiar with the term or don't know the definition that we usually use, a correction is viewed as when the market falls by at least 10%. Corrections happen every year or two. So you can go into any year expecting at some point that the market's going to correct. Where to have holdings in preparation for a market?
Yeah, probably 8 out of 10 years ago.
Okay, it's 8 out of 10, thank you. Where to have holdings in preparation for a market drop? I mean, look, if you are thinking the market's going to drop, the one thing I'll tell you is that a lot of money can be lost when we wait for the market to drop, because it doesn't always do that. But if you have money that you are putting aside anytime, it's for a short-term need, whether you think that there might be an opportunity in the market, and so you don't want to put it all in. And like what I do right now, when I have people come to me with money to add to the market, I am concerned about the valuation. I won't deny that. So the typical way that I approach it is, let's pick a length of time that we're comfortable with, and we're going to work our way into the market over that period of time. Maybe it's 6 months, maybe it's 3 months, whatever the number is. We're going to take the amount that we're investing, we're going to divide it into equal pieces, and we're going to put a process and plan in place to invest it over a period of time. What's the advantage of that? Well, if the market is highly valued, we didn't put all our money in at this high valuation. On the other hand, if we're wrong and the market isn't highly valued and it continues to go up, well, at least we got some in now. So that to me is the safest way to approach it when you're concerned about the market valuation. But if you're just holding cash, I mean, really, you don't get much for cash. You got to be careful about having too much cash, because inflation is higher than the interest rate. So your purchasing power is going down. But you want to think about online banks are going to pay a little bit better interest rates than conventional banks, and short-term bonds and money market funds. None of them pay that great, but those are kind of the options for cash that's sitting aside right now. Thoughts on Bitcoin. So I'll tell you that there's another firm besides my own that I manage some assets for. And one of the guys that's part of the investment committee at that firm is a big highly in favor of Bitcoin. We have conversations about it all the time. Every time we have an investment committee meeting, which is once a month, we have a conversation about Bitcoin. If it's a currency, my problem with Bitcoin is the fluctuation in value makes it really hard to view it as a medium of exchange, because it fluctuates in value so much. So that makes it hard for me to think of it that way. Having access to it, I understand that some people want it. For my clients, I don't offer it because Schwab, which is my custodian, doesn't offer it. The only ways that I can even think of buying it are extremely expensive. There is GBTC, which is it's a Bitcoin trust. The expenses that come with that are 2%, and it's traded as much as a 30% premium to the value of Bitcoin. So that means if you saw Bitcoin at $30,000, you're paying $39,000. You have a lot to overcome just to get to even between the expense ratio and that premium. So I don't have a great way to buy it. I mean, I know that there are companies that are doing it. PayPal offers it. If you do it through PayPal, you're going to pay like a 2% commission plus some other fees. It's a really interesting thing. I admit that I'm still learning about it. I'm not ready to go and put money into Bitcoin at this point in time. And like I said, as far as the Super Bowl, if I had my choice, I guess I don't know who's going to win, but I'd like to see the Bills win because they've never won. That's all I got on that. Everybody can unmute themselves if you'd like, And I'm open to any other questions that.
Bill, can I make a comment on the title of today's presentation, which I think is very much on point, about 30,000, then what? Back in 1999, there was a book published called Dow 36,000, The New Strategy for Profiting from the Coming Rise in the Stock Market. This was 1999 when the Dow was floating between 9,500 and 11,500. And to say 36,000 at that time seemed absolutely insane. And indeed, over the 10 years following the publication of the book, the Dow went up and down, essentially went nowhere. 10 years later, pretty much in the same range, about 11,000. 10 years after that, we've had a near tripling. So we're north of 30,000 now. So 36,000 doesn't look so weird. And a bet I'm always willing to make with anybody is that we're going to see 50,000 before we see zero. And 50,000 in 10 years would not be a heck of an accomplishment.
No, it's funny. I remember that book. I think the author was James Glassman, and that was written back when I was covering stocks and managing things.
Glassman and Hassett.
Yeah, I remember that well. And you're right. Like that's the thing too. Like, you know, now we see if the Dow moved 500 points in a day at 30,000, that's
so what?
0.7%.
Yeah.
I mean, it's not that much. You have to look at things in percentage terms, and it's very different. The higher the Dow goes, the higher the S&P goes, the larger the numbers you can expect to see on a day-to-day basis in terms of movement, just because relative to the total pie, it's a smaller piece. And I agree, you know, if you're an investor, that means you have a certain level of optimism about the future. And that means that you're expecting that over the long term, the market's going to go up from here. All right, again, if anybody has any questions, please feel free to unmute yourself and ask.
Phil?
Yes?
Hi, it's Susan. Hi.
How are you?
What is the future, do you think, of the battery, the lithium battery cars, the electrical cars? Is that going to be a huge wave pretty soon?
Mm-hmm.
Beside Tesla, some of the Chinese cars like Neo and XPEV or something?
So I do think that as we have a bigger push towards energy efficiency, becoming more green, that's going to make, it's going to create more of a positive environment for the electric car market. The thing is that while I expect it to happen, I don't know that it happens that fast. And that's because turning over an auto fleet is not something that can happen overnight. Cars, people keep their cars for longer than they used to. I would expect it, I believe the data I've seen said it would take 10 to 15 years to turn over an auto fleet. So while I do expect there to be more of a push and a continued push in that direction, I think it'll take time to.
I think it's going to take that long.
Look at all the outlets that are all over the malls.
Coming out with, they will have them.
Yeah, the GM is doing it too, right? I think. I'm going to fix dinner while you and Phil can talk, okay?
All right. Anybody else have any other questions for me tonight?
Yeah, Phil, this is Francie. I was wondering, how would your presentation tonight, how would it have changed or been different if you talked about other market indexes, about volatility and recovery, you know, NASDAQ or S&P?
So that's an interesting question. I mean, the NASDAQ is certainly.
The Dow are probably equally volatile. The NASDAQ is going to be even more volatile.
Yeah, that's what I was going to say. I think the NASDAQ would be more volatile. Like if we look at it, the NASDAQ went up more than the S&P or the Dow did last year. The Dow and the S&P, while if you were overlay a chart of one on the other, they wouldn't move exactly in concert, but they're much more aligned because of the fact that the NASDAQ is so technology heavy. I tend to think that that's a little bit more volatile than the other indexes.
Okay, why did you choose talking about the Dow?
I mean, I guess the reason I chose the Dow and that's the subject in the title was just because that's like a really big round number. That was the only reason. I mean, honestly, like when I look at market performance, I look more at the S&P than I do the Dow, just because the S&P is 500 companies. The S&P is market cap weighted as opposed to the Dow, which is price weighted and only has 30 companies in it. But the thought was, if I use that title, the Dow 30,000, that's a really big round number, and I didn't have a number like that for the S&P.
Right, understood. Thank you.
You're welcome. Anybody else have any other questions? If not, I'd like to thank everybody for joining me. And again, I will be back in 2 weeks on the 28th, that would be, and that'll be at 12:30. Thanks, everybody. Have a great night.
Thanks, Phil.
Thank you, Phil.
You.
You're welcome.